Good morning, traders. It is 8 a.m. Chicago time. Our time has changed here in the U.S. We are in daylight saving time. It is 8 a.m. Chicago time, 9 a.m. Eastern turn on my news feed. On Monday, the 13th of March, 2023. Thanks for joining me here on episode number 2428, the banking crisis. Big deal here. Derivatives trading is not suitable for all investors. Past performance. I'm on the wrong mic. Okay, thank you. I am not on the wrong mic. Yes, I am on the wrong mic. Thank you for that. Here it is. My voice is going to boom. There we go. How about now? Should be much better. Sorry about that. Thanks for mic checking. Mic checking me. How's it going now? Okay, so there's a lot to cover here. Let's dive right in to the pre-market summary sheet. So Silicon Valley Bank ran into trouble. You saw the big move on Thursday. That was the big drop. And that bank became insolvent right quick. There's just a lot on the news feed today, so we'll try to get through it real quick. So that bank became insolvent. It was not. They were not able to bail it. Okay, I'm back. Sorry about that. Anyway, there's a lot going on here. Anyway, the collapse of SVB, Silicon Valley Bank, is complete. The bank is insolvent and has been absorbed over the weekend. An additional bank, Signature Bank, was taken over by authorities. This is also a significant development. So what this is doing is it's shaking the stockholders' confidence in the banking sector. And so what we have is a market that is responding that way, even though the Fed created a way for this to be managed. The markets have lost confidence. If you look across the board here, you'll see that the financial sector has Bank of America down 3.77%, Wells Fargo 3.53%. These are quite significant for banks, American Express, and so on. So that's where we stand. So what this is likely to do is create a market environment that is very, very much about the news feeds and what comes through. So this is where we stand. In addition to that, this week we have some significant numbers. There's core inflation coming out of the U.S. The inflation rate coming out on Tuesday. The next FOMC meeting is on the 22nd, not this Wednesday, the following Wednesday. So we have CPI on Tuesday, we have PPI on Wednesday, and retail sales. We have the ECB on Thursday, which, by the way, the market has priced in a low probability of a 50%. What is going on? A low probability of a 50% hike by the ECB. Current rates 3%, expected at 3.5%, and things have changed dramatically. So what the market has done is it has actually cut the terminal rate down for uh, man has cut the terminal rate down for where the Fed is likely to cap out. It dropped it by 100 basis points. This is very significant. The market's also pricing in, and by the market I mean the Fed funds rate is also pricing in a 50 basis point cut by the end of the year, and the market has priced in a much lower probability of of a uh, uh, a 50 basis point hike in the next round, maybe even not hiking at all. So this is all well and good. Um, this is all well and good, and it's basically saying that interest rates may go down, which has been positive, but it's also saying that there's trouble ahead, that the smart money is factoring in a lot of trouble. So we have Tuesday CPI, Wednesday PPI, Thursday ECB, Friday Eurozone CPI, University of Michigan preliminary. We have this is a rollover week. We have expiration on Friday. So we're trading in the U.S. indices. We're trading June contracts, which, by the way, just in case you had not seen this on EdgeClear's Twitter feed, also Convergence, we have the roll adjustments. The roll adjustment for March to June is plus 34.75. The NQ is plus 128.75. The YM plus 247 points. EMD 19.5 points, and the RTY plus 15.5 points. This is how much you have to increase the prices of all expired contracts, including Marches, and expiring contracts, I should say, including Marches, for them to be adjusted properly to the current front month, which is June 23. So we should be trading ESM3, NQM3, or the micro versions of that. Someone asked me a question about why the price adjustment or the premium is so high, and the reason for that is as the contract is priced today for expiration, it carries in it, the futures contract carries in it the value of dividends and the value of interest. And what we've seen is that dividends are subtracted from interest. Interest into the future is generally positive, but interest rates have been so low that we've had actually negative roll adjustments. And now with the interest rates being high, there's a lot of time between now and the expiration, the third week of June for the expiration, and that compared to the fact that March expires this Friday. And remember, when a futures contract expires, its value should tie in and collapse with the SPX, the underlying product, the SPX or the NASDAQ or whatever it is. The March contract this Friday in the future should equal, at settlement, should equal or be around the cash price of the underlying market, the underlying index. This is very important to know. And so the future contract is going to have a lot of interest in it because interest rates are so high, short-term interest rates are so high. So the number of points to pay off that interest to expiration in June is quite high. This is why the premium adjustment is so high. In any case, make sure your platform is adjusting for that. So for those of you, I was going to cover what happened here with the SVB and with this bank collapse, but I don't think I'm going to do that. The summary of it is SVB is a very tech-focused bank and has seen incredible amount of inflows of deposits through the 2020 COVID pandemic crisis, and it saw the opposite as tech firms, made bank and deposited a lot of money. So it's been doing really well. And then what it saw last year, though, is money's just been flowing out. Money's been flowing out, and those deposits, 200, I believe, around 212 or 230 billion dollars. A lot of those deposits are held in 10-year notes, 30-year bonds on a maturity basis, and the value of those has dropped dramatically with interest rates going up, and so the bank could not be what is going on. The bank could not provide liquidity to its customers. So all these customers came in, wanted their money because basically there was a run on the bank because there was information that the bank may not have the cash on hand because it's tied up in the treasuries. So the bank has the money, most of it, but it cannot get it out of the market, cannot liquidate it until it matures, and so that's what happens. That's what happened. So it's not like the bank went bankrupt. The bank went bankrupt because it didn't have cash to pay depositors when the money was demanded, and that's why the Fed is stepping in to support. Many banks are regional banks are probably in that position. So you're going to hear a lot on the news feed about regional banks and regional bank confidence dropping, and that's why the Fed stepped in and is guaranteeing on par value the liquidity for those securities and allowing banks to borrow from the Fed for the value of those of the paper that they cannot get out. Here's the interesting thing, just in case you're into politics a little bit. SVB has been lobbying for years and years and years to raise the threshold for where they require a risk manager, and that threshold's at 250 billion. The bank has kept its deposits at 212 to 230 billion, and so they didn't have a risk manager. Normally, banks handle this by going into the swap market or whatever, and this bank decided it didn't need to do that. So it got called and has overnight basically collapsed. So Goldman Sachs, given recent stress in banking system, no longer expects the Fed to raise rates at the March 22nd meeting. This is quite significant, but you know the market's been falling. So let's look at the market. Strong risk off this morning. Europe just taking it in the teeth in the banking sector, in the financial sector. Look at crude oil down 5%. What the market seems to be pricing in is a recession here. This is what it looks like. This is what Jeff Snyder and Macro Alf and Andreas Steno and all of these guys have talked about a lot, in that there's likely to be a point where the Fed is going to have to reverse because things are very likely to be much worse than they expected. So if you look at money's moving into these safety assets, metals, and so on. It's moving out of growth assets, which is growth commodities, which is crude, these big inputs. Look at the treasuries. The treasuries are up big this morning. And when the treasury note is higher, when the price of the treasury note is higher, the underlying yield, or the yield attached to it, goes lower. So what the market is pricing in is that yields are dropping. So that's happening across the board. The Bund is even seeing the same. These are significant moves for the Treasury market. Turning to the S&P has traded 660,000 contracts so far, much higher than what we would consider normal. The inventory is just 29% long still, because the market actually opened today with a rally and sat there for quite some time before coming back to settlement, with the point of control now right at settlement, essentially, or hovering around settlement, and so it's the inventory is kind of messed up. 132 points of range, quite wide, twice the expected value, and so what we have here is very high volatility. A very good day to be very clear about your risk management. We have a multi-distribution profile. Let's get into the chart here. We have a multi-distribution profile going on right now in the S&P. The market is in price discovery mode. It has basically whipped both ways. And so again, it opened, rallied up, rallied way up 39.70 or so, and is now about 130 points lower. So this is quite a significant move here in the S&P. If we look at the shorter term chart, you can see that we've basically tested above, just above Friday's high here. We've recovered, basically opened in a small gap, pulled back, and then we've recovered, and we tested almost just above Friday's high, came all the way back to the middle of the range right here, settlement, and then have fallen through. Currently, the over-under line is settlement. Right now, settlement is likely to be the magnet, the over-under line. Also, the settlement on Friday is in line with the yearly settlement for 2022. So we have the overnight point of control, we have settlement, we have the century figure, and we have the 2022 settlement all in that price zone in the 3,900 right now. So that's where that stands. Quite a bit of activity, but you'll notice that the relative delta here is not being too dramatic. Price is really moving, whipping around on its own. It's got small lots controlling it, large lots on the opposite side here. This to me is a concern for continuation type trades. This looks to me like it is very likely to be a gap to settle trade on the open. The market is currently panicking, and it is very likely to want to recover to where balance, short-term balance has been. So what has happened since Friday, right? What has happened since Friday that is causing this kind of whipsaw action? It's very, very simply, everybody was scared and expected that depositors would only get 80% of the value of their account, which is a disaster for the banking system. And what has happened over the weekend, and notice this stuff always comes out over the weekend. What has happened over the weekend is that they've had 2 days to figure out what to do, and what they've done is basically guarantee those deposits. So really, what is the problem? The problem now is the unknown. There's a risk overhang. So we know what the SVB's fate is. We know what Signature Bank's fate is. Now we're looking at, okay, who else is holding garbage just like they did in 2007, 2008 that we don't know about, and that's what the market is pricing in. Remember, the market always prices in risk of the unknown. So what you have is really a bank that had the money, just didn't have it in cash. So I wouldn't call this the market, the government stepping in to save another bank, because the funds are there. It's just that it could not be liquid. So to me, what is the real problem here, and why? And for that reason, I'm thinking we head back to settlement at the open, but also not for the fundamental reason, because I'm not a fundamental trader, but overall, the expectation is that, we have tested below, we've come back into the range technically here. We're trading inside of Friday's profile. It is very likely to get back or open in value here. And if it opens in value, the point of control and settlement are very high probability, very high probability. So that's what I'm looking for this morning for the primary idea. Crude does not look the same though. If you look at crude has taken out the last month's low. It is trading in a very on the extreme. It's very close to the $70 extreme low of this range. It's got a big gap. Crude does not look so hot. Crude is very likely to have responsive buying, but this is a massive gap I don't have the stat in front of me. I do have stats for the gap size, just don't have it in front of me. But this is a massive gap. Crude might fill some of this gap in, probably with a lot of pain. But crude is not expected to make its way back to a gap fill here. The S&P is opening pretty much just tilted off balance just by a little bit. Remember, the S&P is off by, let's look at this, the S&P is off by 30 points from settlement, 31 points. That's about 3 rotations, 3 full rotations. It's not too crazy. Okay, that's all I have for you for today. I don't want to go nuts here with this stuff, but you can see here crude is attempting to be responsive, good delta lifting. Price isn't really going with it. See how the delta is rising, but price isn't. This is essentially what this is saying is that the lifting is being absorbed by price, by the offer in crude. Most of it's happening in small lots. Crude is very likely to have a hard time to continue. So the question is, when does this buy program get done so these guys can sell it? Okay, so that's it. I'll leave you with that. Good luck today, and I'll catch you tomorrow morning. Take care.